We are once again back together talking about private equity and how these gentlemen on stage are allocating capital today. We have a great group this year, and I'm happy to be back with you once again. So let me introduce our all-star panel here. From the left, we've got Robert Smith, founder, chairman, and CEO of Vista Equity Partners. Steve Schwarzman, chairman and CEO and co-founder of the Blackstone Group. Jonathan Nelson here on my right, founder and CEO of Providence Equity Partners. Jim Coulter is the CEO and founding partner, TPG, co-chairman, leading education by advancing digital commission. And on the end, of course, is Leon Black, chairman and CEO of Apollo Global Management. Thanks, gentlemen, for joining us today, and thank you all for being here with us. Every year, I kick this panel off and try to get into how these guys are allocating capital and where they see opportunity in the markets. We will get there, but I thought we would kick it off today with how the industry has changed. And of course, we know that with the emergence of new regulations, the banking sector has been pushing some business off, and in many cases, private equity has been a beneficiary. Steve Schwarzman, can you kick us off and tell us how your business has changed in the last 2 years?
Well, I'd just like to thank you, Maria. I don't think we can quite equal, Hank Paulson and Bob Rubin and Tim Geithner on this stage, but we'll do the best we can. The industry has always been changing. We really started out just doing leverage buyouts, and that lasted for a while. And like all good things, it had a great run through the 80s, had a little dip, and had a pretty good 90s, although prices were higher for a while. And what happened is different firms started, one of the big trends is not just doing a standard leverage buyout deal. Those types of investments migrated to growth type deals and acquisition plays where you built a business. But what also happened is you started going into different asset classes, which now is a pretty acceptable type of thing. And we started, for example, with the recession in 1990, going into the troubled company advisory business. Then we went into real estate when that collapsed, and credit at the end of the decade, and hedge funds right around the 1990s, adding different investment types which had high returns and lower risk, we thought, which turned out to be true. Now we have another trend, which is after the crisis, really much more intensified governmental regulation. And it affects us principally that certain, what I guess we would call traditional financial institutions aren't allowed to do what they used to do. In some cases, there was more risk. In some cases, there really wasn't. But they just were stopped, either had to roll down those businesses and get out of them, or they sold them, or their people abandoned them because they couldn't get paid because of other restrictions. And I think for everybody up on the panel who aspires to a broader basis, although just staying in the typical private equity business can be a very good business, improving companies and so forth. It's a good business. That this other opportunity is really big that I'm talking about, and it's also global because regulatory reform isn't limited to just the United States. You see it in Europe as well, and this gives us opportunities which, to varying degree, people up here have participated in terms of extending credit to different types of people who want to borrow it. The key for us is not to have short-term liabilities because that's really the safety or lack of safety, if you will, that was part of destabilizing the global economy. So there's more stuff, and also another third trend is really globalization. And for the people in our industry, we found with some mixed experience, but on balance, that we can go around the world with different of our asset classes and that creates a whole new sense of opportunities and places to invest well, and we're taking advantage of that. So it's really been a exceptionally dynamic time for well, they still call it the private equity industry. It really isn't. It's really the alternative asset business, and I'm sure somebody will come up with a better name at some point than that one, but that's what we're working with as of the moment.
And I'm glad you mentioned international, because the strong dollar certainly has enabled so much. Jim, Jonathan, Leon, can you weigh in here as well in terms of how the business has changed? Any changes that are of note from your standpoint, Jim?
One of the great things in private equity is we get to look at a lot of different businesses, and we often don't look enough at our own. I would say one of the most dynamic businesses that we're in today is our own business. We've gone from a small cottage industry into an industry today that is managing, what, 2 trillion, 1 trillion? It's no one actually knows. And underneath all that, it's probably the biggest trend today in asset management, which is a bifurcation of the market. On one side, publicly traded securities are going passive, but more and more allocators of capital are looking for edges to find alpha in the market. And traditionally, those edges are growing most quickly and appearing in the most interesting ways in alternative assets. So I think what's interesting for all of us in our careers is we started picking companies, and today we have this two-pronged thing that we have to do. We have to wake up every day and buy interesting assets and companies, yet we also have to manage these organizations that are trying to deploy that around the world. And that combination, which I think, Steve, his firm is doing fantastic at, Leon's firm, the ability to both invest well on individual deals and build the replicable ability to do it across the world, that's really hard. And that's what these platforms have to achieve.
Leon?
I'd say there's been also a change in the relationship between the GPs and the LPs. I think that today there's a lot more transparency in terms of the relationship with all our LPs. I think the LP base has broadened significantly. When I first started, I'd say we had 80% of our investors were in the US. And I'd say today it's about 50-50 as the sovereigns have jumped in from all over the world. I think that in addition to that, unfortunately for us sitting here, but nobody's crying for us, is that there's been a little bit of fee compression that the LPs have dictated, and that's a reality also of a changed world. But I think overall the relationships with the LPs has become much closer. One of the other big changes is what's called the development of special managed accounts. Today, we probably have $20 billion of special managed accounts with key LPs that want to take advantage of what we can offer throughout our whole platform. Some of it's direct PE, some of it's credit products, some of it's real estate. And then finally, I'd say the other thing that has changed over time for some firms, and there's both good and bad to it, and I think if you look up here, it's happened to 2 of us and not to 3 of us, and I think we're all doing just fine, is that some of us have gone public
Right.
At this point, and some haven't. That would be another development.
That brings with it, of course, its own changes. Jonathan, have you seen change to your business?
Oh, sure. While I agree with my 3 fellow panelists, and notwithstanding the fact that I've been encouraged to disagree by you and
I did not encourage you.
liven it up, and
I just asked you to be
but
interactive.
I haven't heard a sentence yet that I disagree with. So if I did, it would be for sport, but it wouldn't make sense. I completely agree with the comments, but it's interesting that, first of all, this is still early days. While the change has been dramatic and has affected all of us in our businesses, it still feels like it's, to use a baseball metaphor, it's somewhere in the first 3 innings. It's far from where it will evolve. In our spaces, if you look at the top 5 firms, that is less than 10% of market share, which is different than what you see in large cap public equities, for example, or even fixed income. So it's early, and there's much more to play out. And the other piece, which is interesting to me, is not to probably folks in this room, but to the larger world, folks who are not here. We all sound the same. It's alternatives, it's private equity, whatever that is, and whatever they think of us, we won't go into that, they would probably paint us with one brush. When really, when you're a practitioner or an investor, you see real differences in how we prosecute our businesses. And this is among very good firms. There are different approaches, there are different winning strategies, and it has a long way to go to play out. I mean, for us, we started as a specialist firm in equity, and today half of our business is in credit and in fixed income. And I would never have predicted that 15 years ago.
And many on the panel, in fact, have been focusing more and more on credit. And so we'll get into that. Steve and Leanne, I want to get your take on that as well. Robert, then there's just the change of what to invest in. And you have made a name for yourself in terms of investing in technology, software in particular. And that really is changing every industry today. Technology is. So what are you seeing?
Yeah, it's interesting. Just to extend a little bit on some of the comments that were made. In my mind, there's a little bit of a tale of two cities beyond what was described, and they are, I'll call it the big generalists. And these are folks, frankly, who have the opportunities to capture massive amounts of capital. You see very large sovereign wealth funds and others in a zero or negative interest rate environment saying, where do I deploy this capital? Who can handle this capital? Who's responsible? Where there's only a half dozen names on this planet who could deploy multi-billion dollars worth of capital responsibly every year. And hence you have the expansion of the AUM from some very talented firms out there. Then you have what we call the rise of the specialists. That's us. That's where we live. And what we do is bring a very specific way of transforming businesses as opposed to being transactional and call it an asset management play. We have a systemic way of actually creating value in each one of our businesses, which involves a fair amount of investment in our transformation teams, investment in our management teams, and the repurposing of those teams to capture above average returns. Now, what that has led to, again, is now, from our perspective, a flow of capital our way, an opportunity set to really go dominate certain marketplaces. And the good news for us at Vista is we're in software and we're in technology. And if you've been paying attention at all today in these panels, technology is changing everything and software is changing everything. Every single industry is being disrupted. And I'd be curious, the folks on this panel, when you're going through your investment committees, are you asking that question? Okay, well, what's going to disrupt this business? What technology is going to disrupt this business? There's 3 billion new minds coming online on the internet. None of them have anything to lose. We have things to lose.
What do you mean 3 billion new minds? In other words, population growth?
Population growth with access to the internet, with computing power greater than what we had putting man on the moon back in the 60s. So all of a sudden, they can develop a product, to disintermediate any one of the businesses that are owned by private equity folks in a short period of time. They can reach 1 billion people in a matter of minutes with an idea, and in some cases in a matter of months or years with subscribers. Those are the sorts of risks that our business now faces, that if we aren't on our toes and aggressively moving forward and embracing the opportunity, it's challenging. Part of what we do is we partner and we look for different carve-outs of very large corporations and say, how do you now transform the assets that you have into digital assets? And once you have that opportunity set with a trusted provider, which is how we're now viewed, that's where the growth prospects come for us.
So I know what's happened in sort of the consumer media market with, mobility. And I think I know what's going on in healthcare in terms of sensors in our bodies. If you can name 1 or 2
Sure.
industries that are being changed dramatically as
I
a
will
result.
give you a class example.
And where are we in that? In the beginning is what
Sure,
I'm looking
and one of the simplest and easiest is cybersecurity. We just announced a deal with Raytheon. Now, if you think about it, in Davos last year, not to use another economic forum to have a conversation, but the number one topic was cybersecurity. And if you think about these executives and the businesses they run, if they are not thinking about a cybersecurity strategy, they are putting their capital at risk. Well, we partnered with a business, Raytheon. If you think about a defense contractor who thinks about cybersecurity from the inside out, with one of our companies that does it from the outside in. And when you put those businesses together with that sort of technology, that sort of a platform, with a software operator, you can actually provide businesses and create companies that then can go dominate their space. Those are the sorts of ideas, and that's just one, and it's in every single industry where you can carve out these assets, combine them with strong specialist operators to actually drive the opportunity for private equity investors.
I'm going to drill down on that more because we want to know more about what is most valuable within cybersecurity, because that's a big topic, so we'll get back to that. Few industries have been as changed as media and telecom as a result of technology. You're a big investor in this area. What have you seen, and how do you see this industry changing, Jonathan?
Oh, gosh. I mean, that's the one thing that we rely on and encourages us in finding, the next wave of growth is that there are constantly disruptive technologies, whether it's in distribution or in content. And in media and in telecom, it has always been about that tension between distribution and content. It's mutualistic. They depend on one another. And we're seeing it today. I mean, we had Comcast. For a deal that's not going to happen, it's going to have wide-ranging effect. That's unusual. I mean, we've just spent 14 months considering what the world will be like with one company controlling 57% as the FCC defines and DOJ defines the market of broadband over 25 megabits per second. What will that world be like? Well, now that's over. We just spent a lot of time talking about it. That's not going to happen. So what will happen? Which we've only had a few days to think about that. And it's dramatic. It's dramatic for consumers, maybe in the short term, not a good thing, because Comcast does such a good job in digital distribution. It's probably a happy day for content owners not to deal with someone so powerful on the distribution side. I'm speaking for them. I'm not claiming that to be a fact. We're in the middle of what was a great debate for years about the bundle, the big bundle that probably everyone here experiences. It's either a big bundle or nothing. But judging by the age of this group, my guess is it's a big bundle plus over-the-top services and very few cord cutters in the room, just by demographics. And so the cord cutters, that's the a la carte, they're only going to pay for or take what they want. My guess is it won't be either one. It'll be something in between. It'll be skinny bundles. We've seen Sling. We've seen Verizon. We're going to see Apple. We just saw CBS. There's going to be a wide array of possibilities of how you actually get premium content. I'm not talking about YouTube. I'm talking about the most highly prized content in what we used to call television, which isn't really about television anymore. It's about media. Screens. It's about a tablet. It's about a phone. It's not the big TV in your living room. Wow, all that this year. That's breathtaking. We used to go decades, we thought black and white to color. Probably just lost a lot of you with that one, but that was a big deal. Now we're talking about how you're going to get content on what kind of device. You'll be mobile, of course. I saw a stat the other day that 88% of U.S. population between the ages of 13 and 18 stream movies and television shows. That's tomorrow's. That is the market for tomorrow. That's not maybe, that's definitely. So yeah, I think it's dramatic. And the most important piece I didn't mention, which I think is sports, will in the end determine what wins and what loses and the shape of the industry.
There was a report earlier today that Time Warner Cable had reached out to Cox about a deal. I mean, look, now that Comcast walks away, is it fair to say Time Warner Cable is in play? Will this company get acquired by the end of the year?
Well, I would take the CEO at his word, and it also makes sense that they may even be an acquirer. Their standalone business model will work. A lot has changed in the 14 months since they agreed to a deal. So we'll see. There'll be M&A, but it's not clear. I think most people think, well, Charter will just buy Time Warner. I wouldn't say that. I don't know. How could anyone know except that Charter's very interested? But a lot has changed.
So you're saying there will be some more consolidation, but we don't know who's going to be the acquirer.
Yeah, I actually think consolidation is an unpopular topic in Washington. I think consolidation is a good thing for consumers. It has to be well managed. It has to make sense. But scale matters in this business. I mean, there's a reason why that one distributor seems to get the highest marks for best performance from the consumer experience just by the simple definition of data rates. They get to spread it over a very large installed base. That's a huge advantage.
Jim, you want to jump in here?
You know, I've paid almost no attention to what's going on at Time Warner. And we bought a lot of cable back in 1989, 1990, because our job is actually to find industries that are consolidating. I totally agree with you, Jonathan, that it's gotten to that point of consolidation. So the question is kind of what's next? And our job is in an environment where we think multiples are going to come in. Because if I took if I took a poll here, I'd say most people would say they're worried about interest rates going up and multiples going down. What's going to make sense? And you'd love to find an industry that's growing and consolidating. So let me give you my idea for the day. Think about this conference. I was talking to someone about this earlier. One of the big booms in the economy right now are conferences. South by Southwest, Coachella on the music side of things, TED, Davos, et cetera. So somehow in this world where we've all been focused on what's happening digitally, there's this whole other world that's growing up that we seem to want to connect in this new way. So who's going to roll up conferences?
How profitable is it?
I have no idea, but looking at this group, I think if it's not profitable, we're not. So somebody's, I mean, you're here, right? So there's got to something's going on. But
I don't know if I would want to own it, though, but.
I'm kind of interested in, what are the next trends that we're going to be talking about on the investment side? And maybe it's conferences, who knows?
And that's what we want to talk about today. And one of the trends, Leon Black, that you have been really a leader in is distress. I want to ask you about distress. Where is the distress in the world today? And I guess, Jim just said he thinks multiples will come in. Do you think things have gotten expensive?
I think the markets across the board are priced to perfection right now. I think the equity markets right now are priced at about a 12 times EBITDA, which is, I think, an all-time high or pretty close to it. I think, given where the leverage loan market is and the high yield market, in the 5.5% to 6% rate, yes, it's come up a little bit, but given where borrowing costs are in the high grade market at 3.5%. All of this has really pushed prices to very, very high levels. I was somewhat infamously quoted here just 2 years ago with you saying that we were selling everything that was not nailed down.
Yeah, we're selling everything that wasn't nailed down.
And it was because of this environment, which is a very high-priced environment. The average multiple for buyouts in the U.S. over $500 million is at about a 10 multiple today of EBITDA. Inexplicably, in Europe, where there's even a lower growth rate than the U.S. economy, it's at about 10.5 times EBITDA. It is very difficult to generate a mid-20s return in a private equity deal when you pay 10 times or more times EBITDA. You have to really expect, one, that interest rates are going to keep staying low for the duration of your investment, which I think is a tough bet to make. You have to also feel that you can really grow a lot faster than the underlying economy. And in some businesses you can, but on average it's going to be pretty hard to do that. So I think we are living in a high-priced environment where one has to be highly selective in terms of what one buys. As to distressed, I wouldn't call this a robust distressed environment by any means, but that doesn't mean that there's no distress. Of course there's distress. I mean, look what's happening in the oil patch right now. When you have oil prices halved in a 6-month period, that can do an awful lot to the capital structures of companies that have been borrowing for their drilling over the last few years. And so I think there's a lot of opportunity, both on the distressed side for distressed equity opportunities, but even more so maybe on the credit side. I mean, where we have grown the most over the last 5 years since the financial crisis has been in credit. Some of that has been distressed, but a lot of it has just been because of the two secular tailwinds, which are huge. One, low interest rates, which also is what's driving the high prices.
Right.
And so when you have pension funds that have an 8% liability bogey and high grades are only getting them 3% returns, they really are forced now to look at alternative investments. Sometimes it's private equity, but you can only put so much money in highly levered instruments like private equity. So there's a whole spectrum of credit instruments that could make sense for them, where they're not really trading that much risk, but they are trading liquidity for higher yield. The other, which you alluded to earlier, and Steve alluded to, in terms of the secular trend, is the regulatory environment that emerged out of the financial crisis, and that pushed a lot of the traditional players, whether it was through Dodd-Frank or Volcker or Basel III. A lot of the traditional players are no longer able to play in the prop desks that have closed from banks, investment banks, and that has become a huge opportunity for many of us now in our industry.
Right.
So distressed is one aspect. I wouldn't call it robust except for certain industries and businesses, which we're always on the lookout, and we're always looking at the capital structures of the companies in those industries. But credit in general is a huge, huge opportunity today.
So it sounds like it's been a great year for realizations, but not as great a year to find actual valuable opportunities getting in at the right prices.
Maria,
I'd say, I'm sorry, Jim, but in the last 2 years, I'd say the ratio of sell to buy in our shop has been about 4 to 1. Now, recently, it's come up a little because we have less to sell. But I'd say this past year, just in 2014, we sold $10 billion of PE portfolio assets, and we put to work about $4 billion.
Jim?
yeah, there's an old quote from F. Scott Fitzgerald that says the sign of intelligence is the ability to keep two opposing ideas in your mind and still function. And one of the problems we have, and I think I share with everyone on the panel, unanimity in the industry that there's not much that's cheap. And yet, Steve, you have $300 billion, so what are you going to do with it? And I know, Robert, I know what you're going to do with it. Actually, I think software is a pretty exciting and interesting area, but we have to wake up every morning and find interesting ideas, so where is it?
Good.
Well, we don't feel that challenged. For people who don't understand our business, it's a lot different than being a regular money manager who's long only and has to be 100% invested. So I like to say that in our private equity business, we only need to do 10 deals roughly a year, 10 investments. We have 200 people. If you can't find your way to 10 investments with the whole world as your opportunity set, then you may well have the wrong 200 people, sort of working for you. And whenever we buy something, anyone on this panel, We don't buy it like you'd buy a public equity because equities are undervalued or equities are going up or equities are going down and you're shorting them. You're buying them to transform that asset. You're trying to buy it at a fair price, but you're trying to make it much better. So when you exit, you make a lot more money than when you valued the thing at the start. So we all are operating companies. We're not like stock pickers. We're not long only. We're not fully invested. We're like basketball teams without a 24-second clock. We don't have to shoot. I don't feel compelled to shoot. I like easy shots, and I like tall people. And you know, if you can keep passing the ball around and sort of nudge it close to the basket, and somebody goes way up and like smashes the thing in, you know, you could do that if you held the ball for 4 minutes and you didn't turn it over, right? So that's our business, and you have to, if you're running a firm like ours, you have to understand and communicate with your people that is your business, right?
So talk to us about one of your specific deals. Most recently, you acquired the real estate assets, the GE Capital business. You led the deal, $23 billion in assets from GE. What was so important about that deal? And tell us how you see you transforming those assets.
Well, geez, that was not a 4-minute pass it around. You know, that was like just minding your own business, and you turn around and somebody throws a medicine ball at you. This was interesting because it was quite big, but for us it was fun because we were the only people in the world who could have done this. And the reason isn't that we're so wonderful, it's just that our strategy had us located everywhere in the world with each security they were selling. And we happened to have a large capital pool. We were already investing in that area with a team of people. So we could deal the whole thing off from equities, you know, buying the equity in individual real estate assets somewhere in the United States or in Europe or in Asia, mezzanine securities, real estate mezzanine, in those different parts of the world, as well as senior debt. I mean, we ended up buying, you know, sort of billions of dollars of senior debt in Mexico, of all places. But it was interesting. It's almost all in dollars, and it's all to great credits, and it's all barely leveraged. And so in that sense, these are very good, and we could put that someplace. So what we saw with each one of these is that there was an opportunity for us to take our existing people and do something with, we thought, well, time will tell, with these assets. We were not aware that GE was going to basically restructure their whole company around this. They're very good at keeping secrets, or we're very bad at getting secrets from people. So we just thought we were negotiating some immense thing. It was the second biggest real estate deal in history, and the biggest one we did was called EOP. We'll end up making 3 times our money, despite our friends in the media just sort of announcing we would go bankrupt with the thing, which is a whole different issue, apparently.
Well, that was Sam Zell basically selling right before everything collapsed, and then people were speculating, why did Steve buy this at a time that real estate was about to collapse? But
well, you know, we were scared too. So we sold 3/4 of what we bought
right away,
almost instantaneously within a month. So we took our price and moved it up dramatically so we'd be bomb-proof, and then we kept those assets in the best markets and then invested in those properties to make them better and better. So by the time we lived through this, it turned out to be a great success. You can, I know this sounds almost anti-American, but you can buy something from somebody, they can be happy, and you can do well too. You know, I know it's, it just sounds like, sort of you're making it up. But
Somebody doesn't always have to get screwed.
right, you really don't. And Sam got a good deal on that. That was a high price. And, we'll make 3 times our money. That's not so bad. And, the people who bought from us, of course, are casualties. But nonetheless, it's just, that was not good. But in terms of what I guess it was Leon was saying, our ratio is a little different. We invested $26 billion last year, and we sold 45. $26 billion of new investments across our platform, but we're on 4 different areas. That's a lot of investment, and we think we've done a good thing. By the way, everyone who always invests always thinks they do a good thing, and sometimes they're not. So the fact that somebody tells you they're doing a good thing may just mean they're delusional. But we really think we're keeping the same standards that we always have, and we found a lot of stuff. Now, given the amount of capital we had, we could actually put a lot more out, but it's what the world gives you, and you should always just do the best job. All of us, we all do the best job with everything we try and do, and then the chips fall where they will in terms of how much money's out that year or some other year. You can't like worry about things. You worry about doing an excellent job for your investors. That's your only job. Don't get confused. No one is at these firms for any other purposes. Some of them may think so, right? Some other odd department. We're all there just for one reason. And we sort of average around 1,000 basis points over. If you make 1,000 basis points over for 30 years, somebody's going to be really happy with you, right? And that's after the fees, right? Where Leon is right. Not everybody loves us. They should.
Yeah, it's an interesting
We're
point.
lovable.
Maria?
We're lovable.
Yeah.
I would
Go
just
ahead.
add one thing to what Steve said, and I should say I agree with everything he's just said, and I've been a charter member of the Blackstone fan club for a long time, and he's done an unbelievable job in building that firm, and that real estate deal with GE is spectacular, and I hope it'll be really spectacular. But I think the real importance of what happened with GE and what then has been the announcement is that here you have mighty GE.
Yep.
With their finance business, which has been a staple of what defined GE, is getting out of this business now, which says that they have come to a realization that this whole regulatory change that has occurred is not just a transitory thing. It is a permanent thing, and that they just don't want to be regulated to death for the rest of their lives, and they want to move on from that, which I think is a really strong statement. I mean, they're selling off $200 billion of assets, which is really a lot of what GE's been about.
I agree with you. I thought it was a stunner, and actually you and I talked about this briefly earlier when right before we went on the air. It's interesting to see mighty GE sell the things that, frankly, that's where the earnings have been coming from, largely speaking. What are your thoughts in terms of why GE sold?
Well, they sold because they were designated a SIFI, strategically important financial institution, and that comes with heightened regulatory scrutiny. Their business was basically financed. GE Capital was like a huge pile of hundreds of billions of dollars of assets and operating businesses, which actually the assets were always quite good at GE, and they were good operators. The problem was that they were financed with commercial paper that just kept rolling, and when the financial crisis happened, it wasn't in effect GE's fault. People got scared and they didn't want to extend credit, and they got caught needing to roll their paper. By the way, I've talked with a lot of guys who were running the investment banking firms. Some of them had their liability structures out 4 months, 5 months. They ended up giving up too, and they became regulated by the Fed because they realized the markets might not buy their paper. So you had a huge liquidity confidence event. And for GE, it was particularly sensitive because they don't have deposits. So it was just the money markets that were financing them. That was the weakness in the structure. If they had been financed long term, they would have lived right through this. But they weren't, because the difference in rates between short term and long term is high enough. They didn't feel, obviously, from a financial structure point of view, that would work right for them. But I think that's why this has happened.
Mm-hmm.
So what happens when the Federal Reserve does, in fact, start to raise interest rates? Is the party begin to slow down in terms of public markets and even private equity? What will be the effect, do you think, Jonathan? And do you think the Fed will start raising rates?
Well, it has to, and I think we've all referenced it, that we have to assume sitting here that rates will move up. What the rate is, no one knows. Actually, the Fed itself doesn't know, because if you looked at polls of the Fed members this year and a year before, they're remarkably different. They agree on where they want to get to, which you can actually get from the website of their own Fed
But even if
website.
we see
But
two
how they
increases.
get there, they can't agree. So how would we know? If the members themselves don't know, we don't know. But it seems like a very good bet they'll either be the same or higher than today. I don't know how it could be lower. We're already negative in some sectors of it, in the world and markets. And that means cost of capital will go up, multiples will fall. We know that. My guess is my behavior is the same as everyone else up here. Every time I'm in an investment committee and I see at some point there is a grid in there which shows returns and sensitivities to exit multiples. And whatever that shaded area is, I'm always outside the range, because I'm assuming we lose a couple of turns because interest rates move up, and then would we be happy with that return? That's what you have to ask yourself. So it's coming. I think already it has surprised most of us how long this party, to use your words, has lasted, longer than one would have guessed. One sitting here, cynically, you have to assume that those that have a chance to influence it, which are typically think Washington, will want to extend it, whoever is there, for as long as possible. Let's push this out, because things are going pretty well. But there is a problem looming, and when you see nothing is stable, that should be one of the lessons of our industry, of any industry, for nothing's permanent. And when you see, for example, in the US, which is a consumption-led economy, 15 straight quarters of increased consumption, okay, at some point that won't happen. What will be the trigger? We don't know. Will it be interest rates? We don't know. No one knows. I haven't met anyone who knows. But it seems likely that what began as a giant experiment, and by the way, expertly managed at the outset, to save us from going into the abyss, the financial crisis.
Right.
Brilliant. But ever since, we're in territory that is unprecedented. So how would we really know how it unfolds?
Well, at the same time, though, you've got the corporate sector probably the healthiest that it has been in a long time in terms of earnings. So the earnings really are there. And I guess, Robert, let me turn to you, because your space is one of those spaces where you could question things, right? We were all there in 1999, and we saw, the dot-com boom and then the dot-com bust. Is it really different this time? I understand that software is changing every industry, but are you actually seeing profitability sustained?
We are, and I'll tell you what's interesting to Philip, or to follow on some of these comments. If you think about what has actually occurred with this shifting, this dynamic of, the banks no longer lending to corporations and, GE, saying, you know what, we're just not going to be regulated, let's move out of the way. What that has done is actually create a massive opportunity for folks on this panel and sovereign wealth funds to now think about how do we move some of our assets that are in this negative interest rate environment or flat interest rate environment directly into assets that are producing cash flows, earnings, can pay back debt, and actually get equity returns. Now, that's the underside of this thing that I think is going to be really interesting. Even if the Fed does start to increase rates gradually over some long period of time, the largest of the investors out there are actually standing up teams. They are building teams to do direct investments. And it won't be too long as they move the direct investments from the private equity world, their alternatives. They're already taking, big stakes in infrastructure assets and real estate assets and private equity assets. And ultimately, you'll see them start to move directly into credit. Now, what do they need for that? They need infrastructure. They need systems. And we are seeing a massive amount of selling we own a company that's one of the largest in the world for core banking, treasury management, risk management, and it's growing phenomenally well because I call it the shadow banking world, but it really isn't. It's just non-regulated banks. Some of you folks actually fall into that category.
We're not banks.
Right.
We don't take
They are not
deposits.
banks.
We're not banks.
Exactly.
Shadow banking is some kind of a weird thing that somebody came up with because they lack, verbal skills.
Right, right. But what they have is capital and access to transactions. And as they're doing that and structuring these deals, what you're seeing is they actually understand the businesses a little bit better in some cases and now actually providing much more favorable terms. So at some point in time, that part of the market will expand to a point where it will be interesting if it will retract to the extent you actually have a change in the interest rate environment.
You said cybersecurity is a big area for you. Where specifically?
Specifically, every single company needs it. That's the point, right?
I mean, how do you protect your data, bottom line? Can
It
you
is,
really?
the way I think about it is you can never win, you can only tie. Remember, the bad guy only has to beat you once. And if they beat you once, it can be catastrophic. So it is a constant game. And you have to constantly have the best security at all times, inside and out, and you have to constantly upgrade. That's why we like that business to be in. But it is something that if you have any intellectual property at all sitting on any server anywhere in the world, you need to be thoughtful about it. So that's how we think about it. And you have to take a global approach to all of your assets and your asset deployment. And the more that you move your assets into a cloud-based infrastructure, those assets sit out there.
So name one company that's doing it right.
Well, our company, WebSense, obviously, and then we just combine it with Raytheon. That's going to be, I think, a spectacular winner in the space.
Want to get into credit? Oh, go ahead, Jim.
Yeah, so Maria, I'm actually a little more optimistic about private equity. Our job is to play the hand we're given, right? We can't affect whatever interest rates are going. So I would have preferred to have had a hand that was all aces as it was in 2009 or 10. You could have bought anything, but you could have bought the public markets and done just fine. Right now, we're drawing a hand that looks more like a pair of sixes. But private equity can play that hand particularly well. So what's our hand today? Our hand is multiples are going to come in. When multiples come in to make our kind of returns, 20%, it's pretty tough. It means that you have to have extraordinary growth of some sort, which means growth is going to come from either a particular industry or company that's growing or something you're going to reposition. So software, massive disruptions going on. I agree with you, cybersecurity. This is an opportunity and private equity can go in and actually create or change these companies. We can get involved in things that have to be repositioned. So relative to the public market, I would much rather be playing private equity well played today because we just have more tools. So I wish I had a better hand, but the hand we can play much better than other asset classes today because we simply have more tools. So I think it's a pretty interesting time for private equity. I learned I got to hire taller people, and if we could just buy $20 billion portfolios of real estate, it would be good, but there are lots of things to do, right? There are lots of
Well,
things
there are
to
also
do.
like unique situations, like recently you acquired Cirque du Soleil.
Right, so I read some of the press about that. Really interesting brand, the highest net promoter score we've run across anywhere. And yet I read some articles that, boy, they could use some help. Great, right? That's what we're there to do. Find really interesting situations that maybe haven't been optimized, situations you can't play in the public market, and actually add some value.
And why is that so unique?
Well,
Cirque du Soleil.
First of all, we talked about events. So Cirque du Soleil is the #1 live event organization in the world. So you probably have experienced Cirque in a show or maybe in their blue and yellow tents. You probably don't know that they sell more tickets every year than all of Broadway combined. And they had one particular product that you're probably familiar with, but they're just going into third-party IP. They're just beginning to look at growing into China, et cetera. So here's a well-known brand that hasn't been optimized, and we can help them go by keeping all the great things they are, but take them to the next level. That's the type of thing that alternative investments can do. It's the type of thing that actually is interesting at this part of the cycle. We are no longer in a just macro world. We are in a stock picker's world. And our job is to pick the right stocks and do the right things with the companies.
Did you want to?
Yeah, no, I completely agree. It's easy, and I think probably the winning argument to have concerns about macro. But the beauty of our business on the PE side, it's micro. What we do, we don't invest, this is probably true for all of us, we don't invest today in a private company unless we think we see something that is not appreciated by others. We can change the course of the company, that we have, some of us approach it by domain expertise, some of it may be from a balance sheet perspective or other approaches to change a business. And if we, at Providence, if we think we can't change the course of it, we don't even bother. Someone else can buy it and they'll get whatever the market return is. And we look at business. We actually did take a close look, and I agree about live. In fact, I owe Jim, because conferences, we just bought the biggest European conference company, and I thought it was a setup. And so I think that was a great idea of the day, and I love it that it was a minute after, not before, because it would have cost us some money. But live events in the digital world is, that's the one thing, it can't be pirated. It is experienced in a community setting. There are a lot of attributes that actually, paradoxically, are immune to the threats we worry about. And if you can do a good job, because it is, I agree, it's really undermanaged, what a great opportunity. And that transcends GDP growth in the US, doesn't matter. Or wherever in Asia.
That was sort of the initial reason to buy sports. The live nature just makes it, unique, and you can't duplicate it. Why have so many of you been so aggressive in credit and have been going toward credit? Leon, why don't you talk to about, and I know Steve as well.
Okay. Most of many of my partners and I came from one of the greatest credit schools of the last century, which was the Mike Milken School of Credit. Milken, you see?
Shout out to Mike.
That's the man. So when we first started Apollo, it was in the middle of a deep recession in '90. There weren't a lot of classic buyouts to do because there was no access to credit, and that's why we did a lot of distressed and a lot of restructuring. We were actually buying the debt to get at the company through a restructuring. We also ran a high yield fund. This was back in 1990, 91. That's when we did the executive life deal. So we've always had credit, and studying balance sheets in our DNA. Sometimes the best risk reward is in owning the whole company via private equity. Sometimes it's higher up in the capital structure, and that's why we've always thought that credit made sense also. It's a much bigger field. So what happened in 2009, 8, 9, around that period, you had a huge financial crisis in this country. And as I mentioned before, it was followed by very low interest rates, and it was also followed by a huge amount of regulation. So all of a sudden, for some of the firms that became alternative asset managers and that were comfortable with credit, there was the opportunity to create, if you will, a Chinese menu of products out there. Credit products in the 5 to 7% return of senior debt and CLOs. Products, that were in the 10 to 12%, and then opportunistic products in the mid to high teens. To be able to come to all your best relationships and say, where do you want to be on this risk spectrum within the credit world? And in terms of the products, we're in ship financing, we're in aircraft leasing, we're in emerging market debt, we're in CLOs, we're in all types of mortgage debt, we're in energy credit, healthcare credit. There's just a huge spectrum of products that really fit into what we have always been and who we are. But now you have a universe that's so expanded in terms of demand because of the low interest rate environment that high grades are giving, and also playing to our favor. And I agree with Steve, I don't like shadow banking either, because we don't take depositors' money, we're not levered, but we now are the alternative or the replacement to the prop desks of the banks, the investment banks, in providing these types of products to a huge amount of clients, of investors that need yield.
Somebody came up with the name, and the populace loved it. So, but I hear you. I hear you both. Before we go, and as I wrap up, I want to make sure we give the audience something in terms of how you're allocating capital right now. And every year I ask the group, what is your single best idea? Where do you think is the biggest opportunity in the markets today, private or public? And Robert, I'd like to kick it off with you. What's your single best idea?
Yeah, I would still, again, I think about this world of 3D printing. Everyone's heard about it, but frankly, the technology to develop those products, actually the infrastructure, the software, I think is going to actually lead to a massive disruption across a number of industries.
They're even 3D printing,
Prosthetic limbs.
organ part.
Organ parts.
Exactly.
Right. So I think that whole technology, that sphere of influence will actually, change a number of industries. It may take a few years, but I got to tell you, it will be massive disruption.
Steve, you got $310 billion in assets at this point. What's your single best idea?
There are a lot of good ideas. I feel like Hank Paulson, where he took 20 minutes to answer the one-word answer.
No, you just give us something.
But I think European real estate still is a very interesting idea.
European real estate.
I'll pass the torch over to the rest of the
You got it. Thank you for giving us something. Jonathan, what do you think?
Premium content and digital distribution of it, I think, is going to mushroom, and it's a global phenomenon.
Jim?
Plastics. No, just.
That was good. Very good.
I'll go with healthcare, and the reason is there's a huge disruption going on, and it's not attached to the rest of the economy. So if you choose the right side of the disruption, you don't have to worry about some of those cyclical factors.
Paul Jacobs told me that he was backing a clinical trial, the former CEO of Qualcomm. He was backing a clinical trial that you insert a sensor into your bloodstream, and then your phone calls you and tells you, go to the doctor because you're going to have a heart attack in 2 weeks. Is this the kind of stuff you're talking about, sensors in the body?
You don't even have to get that techy. I mean, there's 16, 17% of our economy that's being totally reshuffled, and there's got to be a way to make money in there somewhere.
Leon, single best idea.
A few years ago, when you asked me that question, I responded, you really think I would tell you my best ideas?
Especially with all your competitors on stage. That's why I have to give kudos to over the people.
So I want to make up for it now and give you two.
Okay. Thank you. See, audience, we keep pushing.
And that's because I like you, Maria.
Thank you.
Okay. One would be energy-related investments, both on the equity side, but especially on the credit side. And two would be financial institutions in Europe on the more distressed side.
Are they still in need of raising capital? The financial institutions in Europe?
Yes. No question. Not even raising capital, they need to shrink their balance sheets.
So there'll be a lot of asset sales?
Yes.
And on the energy investments, is that based on the idea that you think oil prices are going up?
It's based on the idea that if they stay down, there's going to be distressed opportunities, and there are something like $115 billion of energy credit out there of companies that have dropped 20 to 30 basis points, which are pretty interesting if you do the geological and the geographic due diligence. And there's also, to take all the shale in this country, in just our country, to develop it, it's about $2.5 trillion that's needed.
Gentlemen, thank you very much. Ladies and gentlemen, thank you.
You got a great